Sometimes there is confusion about what is EBITDA or EBITDA. Basically, earnings before interest, taxes, depreciation, and amortization. Small business owners also want to know, why is an EBITDA multiple important in a company valuation? Well, my name is Melissa Gragg, and I'm a business valuation expert in St. Louis, Missouri. Let's start with explaining what EBITDA really is, and then we will understand how it's important in determining the value of a company. Many people are familiar with the term EBITDA. A business owner just may not know how to calculate or understand the EBITDA calculation. First, you need to start with your earnings, which could also be called net income, income after taxes, profits after taxes. You get the idea. It's basically what you have left over from your company revenues after you take out all of the expenses. Now you want to start to add back some items such as interest on loans or debt and corporate taxes. You'll also want to add back depreciation and amortization, which is basically non-cash expenses. So now you've determined an earnings level which you can compare to other companies in your industry. The point of EBITDA is to eliminate the factors a business owner has discretion over, such as the type of debt financing and capital structure, whether it's taxed as an S Corp or C Corp, and if the assets are depreciated using accelerated methods such as Section 179 depreciation. So once you eliminate some of these items, then you can look at the company's EBITDA level and compare it to an EBITDA multiple derived from industry transactions, mergers and acquisitions, or industry reports. In the valuation of the company, there are many methods to consider, and one of them is the market approach. This is the approach that uses various market multiples, basically what companies have sold for in the open market, to determine the value of a company. And one of them is a multiple of EBITDA. For example, there may be consolidation in your industry, and private equity groups or large industry players may pay 6 to 7 times EBITDA. This means that the value of the company would be in the range of 6 to 7 times your EBITDA number. Multiply 6 times that number. So of course it's not always that simple, because a buyer would have to consider many factors in order to determine what they would pay for a particular company. But it does give the business owner an idea of the range of value. Buyers will also look at adjusted EBITDA, which is calculated by reviewing the financial statements and determining if there are owner's discretionary items such as higher salaries for management, perquisites such as cars, and any other non-operating items such as vacation homes, expenses or non-recurring income, or expenses such as loss from a fire or income from a sale of an asset. Basically, a buyer would look to normalize EBITDA for all of these expenses and income items which may not contribute and continue into the future. This is why it's not only important to understand what the market multiples or EBITDA multiples are in your industry, but also to understand, what does your EBITDA look like for this year, in the past, and then going forward. If you'd like to know more about how to value a company, or if you're selling a business and you have some questions about the value, give us a call at 314-541-8163, or check out our website at valuationstlouis.com.